All right. Good morning, everybody. Good morning and happy Wednesday, all you magnificent melon heads out there. Today is March 6, 2024. The top story this morning is these retail earnings that keep coming in and the tale of two economies that I see emerging, this divergent economy. This morning, we got results from Foot Locker and Abercrombie and Fitch. And dang, if we don't just get two totally different pictures from these two stocks. All right, first things up, Foot Locker, stock getting crushed right now, down 15% ahead of the opening bell this morning. Comparable sales at Foot Locker were down 0.7% year over year. All right, so comps, same store sales, that's the most important category in any retail stock. I talk about that one all the time. We got lousy comps from Target yesterday. Target's comparable sales were down, the same store sales, 5.4% lower for Target yesterday. Terrible quarter. Shoppers, the average shopper in America is getting crushed by inflation. Now, Foot Locker is a little bit unique. That's also a mall stock. Obviously, the situation in America's malls is not good. So it's being somewhat amplified by what's going on with the situation in malls. People just don't shop there anymore. Now, Target stock was something of an outlier. I think you probably had a little bit of a short squeeze going on with Target yesterday. That stock ended up rallying like 12% on that news. It was, even though they reported just a terrible, terrible quarter. Foot Locker coming in, posting a bad quarter. In my opinion, it wasn't as bad as Target's quarter was, but it was pretty bad. Anytime you get negative same-store sales in an inflationary environment, your stock's going to pay the price. And so Foot Locker stock is getting crushed right now. However, it could have been a lot worse. The market was expecting comps at Foot Locker to be negative 7.9%. So when viewed through that lens, Foot Locker outperformed, but not enough to save the stock. However, let's talk about Abercrombie and Fitch now. And again, Abercrombie and Fitch, kind of a mall stock also, but they're doing a whole heck of a lot better. Comparable sales at Abercrombie and Fitch were up 16%. Double-digit same-store sales increases going on at Abercrombie and Fitch. So what does that tell you? Where we've got Target, Foot Locker getting crushed, and then Abercrombie and Fitch doing great. Well, think about the average shopper at the two stores, right? Foot Locker and Target, you're talking more of a middle class, I don't want to say poor, but certainly not rich clientele at those stores. Versus Abercrombie and Fitch, now we're talking pinkies up while you drink your fancy coffee kind of shoppers there, all right? I mean, I don't want to like evoke too much class warfare metaphors here, but obviously a more wealthy clientele patronizing Abercrombie and Fitch versus a Foot Locker or a Target. And so what does that tell you about the state of this economy? The rich are doing great, and everybody else is getting crushed by inflation. And that's been my biggest gripe with the Federal Reserve in this whole time. Every time, inflation, some inflation is good. Remember when the thing started, when inflation first started in 2021, some of these muckety mucks in the mainstream financial press were trying to act like inflation was a good thing because people's wages were going to rise. Still waiting on those raises, by the way, everybody else. But the wealthy are doing great because the wealthy own the assets. The wealthy own the businesses that can raise the prices. And so the shoppers at a place like Abercrombie and Fitch haven't paid the price for inflation that the shoppers at a Foot Locker have. You've got two different economies. If you are lucky enough to have escaped the middle class into the upper middle class or even the top 1%, you're doing fine. You've got even more money to go spend on Abercrombie and Fitch if that's your thing. If you're not, if you were otherwise in the middle class, you have been driven down lower towards the poverty line, or unfortunately, a lot of people driven down below it. By the time you pay your rent, your health insurance, your car insurance, and your food, you've got nothing left. And so you can't even shop at Target. You can't even shop at Foot Locker. And that is these two different economies that we're seeing emerging in the world. And it is all thanks to the Federal Reserve, who is going to be speaking again today. Jerome Powell, actually, he may be taking the mic in just a few seconds here. He's supposed to testify in front of the House Financial Services Committee this morning. And then tomorrow in front of, I believe, the Senate Banking Committee, Powell will be testifying. He's largely expected to say pretty much the same thing he said in January, that we are not yet ready to move on rate cuts. We still don't have enough proof that inflation is moving sustainably towards our 2% target, or whatever Fed lingo he chooses to use in this case. Also going on this morning is the Egyptian pound is getting pounded. Yeah, bad joke, sorry. The Egyptian central bank raised their overnight interest rate by 600 basis points last night. A full 6% increase in interest rates at the central bank in Egypt. That puts it in perspective here, guys. While we're sitting here talking about, are they going to cut by 25 basis points? Are they going to hold, or maybe we'll get a raise by 25 basis points in extreme examples? Meanwhile, Egypt is just like 600 points. Hit them now. Hit them hard. 6 full percent increase in the interest rate over in Egypt. Now, guys, they've already devalued the Egyptian pound in 2023, but it is just getting crushed right now. Yesterday, the Egyptian pound was trading at about 30 pounds to the dollar. Today, it is almost 50, a 40% overnight devaluation in the Egyptian currency. There's expected to be a deal with the International Monetary Fund that Egypt is working on. They also got a large cash infusion from the UAE, or was it Abu Dhabi? I don't remember exactly who it was. But Egypt is also really hurting because of what's going on in the Red Sea right now. The Egyptian economy gets about 2% of GDP just from dues alone for ships traversing the Suez Canal. And that says nothing about all the ancillary economic activity around the canal there. So they're really hurting with what's going on with the Houthis in the Red Sea. And, well, the currency is being devalued, at least partially, as a result of that. Bitcoin went for a crazy ride yesterday. We hit an all-time high in Bitcoin of around 69,200. And then, wham, in a span of just a couple of hours, we went from 69,000 down to 59,300, I think was the low that we touched yesterday. All the while this was happening, we had the largest single-day inflows into Bitcoin ETFs. So there's a lot to unpack going on there. So obviously, if the ETFs were still buying, somebody big had to be dumping. It was Bitcoin whales were dumping yesterday when we hit that all-time high. A whole bunch of Bitcoin all of a sudden goes up for sale. The price crashes. And, well, the ETFs continued to see inflows. So the ETFs were said, thank you. I'll take that cheap Bitcoin. They bought it right back up. And as it stands, at least right before we went live, Bitcoin was back pushing 67,000 again. So, and a lot could happen in the 10 minutes since I hit that let's go live button. So maybe we're at 70,000 by now. Who knows? But a lot of volatility going on here. Look, the price is determined at the margins. I know Bitcoin has like $1 trillion market cap or whatever it is, but really Bitcoin is not a very liquid market. There's just not that much Bitcoin up for sale at any given time. And right now the ETFs are buying it all. And so the ETFs are bidding up the price of the Bitcoin. And somebody with very deep pockets came in yesterday and said, that's enough. We need to engineer a sell-off. And they decided to dump. Now, if I had to guess, I would guess it's some of these high-powered trading desks that a lot of these exchanges are running where they front-run their own customers' money. We've seen Coinbase does it. We know Binance did it, even though they told us they didn't. Well, those guys who are front-running their clients' orders right now, they are getting crushed by this up and to the right movement in Bitcoin. And so every now and then they're engineering these dumps to try to get themselves out from underwater. But somebody, it was some whale, probably a big institutional trading desk, dumped a lot of Bitcoin yesterday. They were able to engineer a momentary crash in the prices, but the buying pressure from the ETFs continues unabated. It's actually accelerating right now. You got a little bit of a FOMO rally kicking in with these ETFs here. And so Bitcoin just absorbed that selling pressure. It tanked for a couple of hours and it came right back up. Gold is also making an all-time high. By the way, guys, while we're sitting here talking about how, the no landing scenario, there's no recession, the economy is great, everything's going to be awesome, why is gold making all-time highs? If the economy is so good, if everything is so strong and AI is going to usher in this new era of prosperity and everything's going to be so great, why are people running to gold for safety? One of these things is not like the other, guys. Gold should not be I'm not saying gold is overvalued here, but if the economy was really as strong as they're telling us, gold should not be making new all-time highs here, and yet it is. If only there were signs that something was up on Wall Street. We got ADP payrolls came in today. The U.S. economy added 140,000 jobs, according to ADP. Take that with a grain of salt because ADP and the private non-farm payrolls numbers that the government puts out have been wildly different the last few months. We get that all-important jobs number on Friday. Jerome Powell is about to take the mic. So much going on in the world today. so little time. Why don't we shrink my big melon of a head and let's see what is going on in the world today, shall we? And by the way, guys, while we're doing that, don't forget that like button and that subscribe button if you're new here. Have your coffee with the melon heads because we do this every morning. And don't forget that notification bell as well. The S&P is up 30 points or 0.6% higher ahead of the opening bell today. A little bit of buying going on in stocks here. The Dow is up 169 points. That's after selling off a few hundred points. What were we down? 400 yesterday in the Dow. Getting back some of that this morning, 0.44% higher for Dow futures. And the NASDAQ, after a brutal sell-off in tech yesterday, recovering about half of that ahead of the open this morning, up 165 points, almost a full percent higher for the NASDAQ. Meanwhile, the U.S. dollar is a little bit weaker here, down 31 basis points or 0.3% at 103.49. It looks like that started right around 8 a.m. Not sure what triggered that. It could be something to do with Powell's testimony today. Although I expect Powell to be a little bit of a hawk today because we've had some stronger than expected inflation reports, hotter than expected jobs reports. Although when you look inside those jobs numbers, they were really terrible. But the headlines seemed like the jobs market was still strong, even though it kind of wasn't. Right now, we have got a weaker dollar. And interest rates looks like a mixed bag this morning. Not much movement in one direction or another. The 30-year Treasury is unchanged at 4.274%. The 10-year is at 4.124. That's down a little over 1 basis point this morning. The 2-year is at 4.533. That's down almost 2 points. And the 1 month is at 5.373, up 1 point this morning. Looking over at the commodities board, we have got gold at an all-time high, 2,145, up $3.40 for April gold futures. That's up about 0.15%. May silver futures at 24.03. Recaptured that $24 level, up about a nickel this morning, 0.25% higher for silver. Congratulations to the stackers. Even the PGM metals are getting in on it this morning. We've got platinum is up 1.4%. Whoa, look at the big move in palladium this morning. Up over 1,000 for June. Palladium futures, 7.8% higher in palladium. What is going on with palladium this morning, guys? Let me know in the comments if you track that one and what's going on there. I did not see that before we went live. Big move happened. Got to be something related to the mining situation in Africa where most of that palladium comes from. Crude oil, April WTI futures is at $79.55. Still struggling to recapture that $80 level, but up $1.38 this morning or 1.7% higher. Take a look at this Bitcoin chart, guys. Again, just crazy movement yesterday. These are daily candles. Again, here, let's zoom out a little bit. The price, we've been watching it go vertical here. And then, we broke through that 52,000 level, went straight up, stalled a little bit at 62,000. Then we rocketed up yesterday, went up as high as 68,000. That was Monday. Then yesterday we go as high as 69,000, sell off hard all the way down to 59,000. All the while the ETFs are buying, bought it right back up. Oh, here comes the dip buyers. And here we are this morning, 66,800, almost back to where we were before that sell-off started. Now, just to visualize it, shout out to Zero Hedge who put this chart out. This goes to show you guys, this is ETF inflows. We've been showing a chart similar to this. Here is the zero line, right where the black meets the yellow. So this black line down below, that's money leaving the Grayscale Bitcoin ETF or GBTC because their fees are so high. And it is flowing into the BlackRock and the Fidelity ETFs and then some. So we still have large net inflows into these Bitcoin ETFs. Actually, yesterday saw more net inflows than any other day since the ETFs were approved, even the first day. Huge amounts of money still flowing into those ETFs. And that's why when the whales come in and engineer these dumps, they're just momentary because it just comes right back in. There is so much buying going on in these ETFs right now, and it's still accelerating. So it looks like this run in Bitcoin could continue for a while here. And again, as soon as this stalls out, we've got the next halving coming up in April. So, get ready for more headlines about Bitcoin, guys. There's plenty more coming. Now let's talk about this big one this morning. And this really had me grinding my teeth about the Federal Reserve when I saw these results. Foot Locker shares fall after heavy promotions lead to holiday quarter losses. Now, I'm not really upset about Foot Locker. I'm upset about the average Foot Locker shopper and what is happening in their life thanks to all the money printing and easy money policy out of the Federal Reserve and the U.S. Treasury. Shares of Foot Locker fell in pre-market trading Wednesday after the sneaker retailer reported a holiday quarter loss issued weak guidance for the current year and said it's behind on meeting its financial goals. Given how poorly its past fiscal year went, the company is now expecting the profitability goal it laid out during its March 2023 Investor Day to be delayed by 2 years. Foot Locker's finance chief, Mike Bond, said it now expects to reach an EBIT margin of 8.5% to 9% by 2028. Now, here's some important numbers here. Where was it? For the fiscal year 2024, Foot Locker is expecting sales to be between down 1% to up 1%. So they're basically forecasting flat guidance, which, considering that inflation is still around 3%, when you put flat guidance out, that means you're expecting your real sales to decline by 3%. That's compared to estimates of down 0.5%. So the guidance was a little light here. CEO Mary Dillon said in a statement that Foot Locker managed to drive full price sales in addition to compelling promotions, i.e. they had to put stuff on sale to get people in the door during the holiday quarter. But the retailer's gross margin fell by 3.5 percentage points, primarily as a result of higher markdowns. And here's the big one here. Again, it's those comps that are so important. Overall comparable sales decreased by 0.7%, which is better than the 7.9% drop that analysts had expected, according to Street Account. So the market was expecting a really bad quarter. They only got a bad quarter. It wasn't terrible. In my opinion, these results are better than Target's results yesterday, and Target stock went rocketing higher yesterday. But comparable sales at Foot Locker and Kids Foot Locker in North America actually increased by 5.2%. So there's some silver linings to this gray cloud here. It wasn't overall that bad, but check out the stock this morning ahead of the opening bell, down 12.5% for Foot Locker stock. Guys, this company probably not going to be around in a couple of years. This is a mall stock, and the malls are just toast. Anybody who's been in a mall in the last few years, it's almost it's a post-apocalyptic tourist attraction. The only reason I have gone to a mall in the last 5 years has been to see how few people are going to malls. That was the only reason I went to a mall, was to like, oh, wow, this is a ghost town. This is pretty neat. There's just no reason to go there. Nobody shops there anymore, and Foot Locker is paying for it. But Abercrombie and Fitch, on the other hand, they beat their holiday estimates as sales soar again, helped by higher prices. And this is one case where the solution to higher prices is not higher prices, because when the people who shop at your store are the beneficiaries of historic inflation and they're becoming stupidly wealthy at the expense of everybody who can't afford to shop at Foot Locker anymore, well, that's a good thing if you're Abercrombie and Fitch. Abercrombie & Fitch said Wednesday that its holiday quarter sales jumped 21% and its profits grew thanks to higher prices and lower raw material costs. The apparel retailer expects its growth story will continue as it issued better than expected sales guidance. For the current quarter, Abercrombie expects sales to rise by a low double-digit percentage compared to the estimates of up 7.2%. So again, we got a little bit of a low guide there, just a little bit. For the full year, it anticipates sales will grow between 4% and 6% compared to estimates of 4%. So in this case, they're saying a little bit better than the rate of inflation. So we're seeing positive real sales growth for Foot Locker. During the quarter, comparable sales grew 16% and gross margin came in at 62.9%, 7.2 percentage points higher than the year ago period. So not only is Abercrombie and Fitch, their comps are exploding higher, 16%. But their margins are expanding at the same time. This company is firing on all cylinders here. Higher average selling prices plus lower freight and raw material costs boosted profits. Analysts had expected Abercrombie's gross margin to be 60.1%. Instead, they got 62.9%. So just a phenomenal quarter by Abercrombie and Fitch there. Really an outlier, deviating from everything else we've seen from the other retailers here. It just goes to show you, if you are in the privileged few, the wealthy class, you are doing just fine in this inflationary environment because your assets are up so much while everybody else is struggling just to put food on the table. Now, interestingly enough, after we watched Target stock rocket higher yesterday on a terrible quarter, Abercrombie stock barely moving here this morning, up 2%, trading at 142.89. That's up about $3 this morning, but their comps were up 16%, and they're only getting 2% move in the stock. Target's comps were down 5.5% yesterday, and their stock rallied by 12%. So once again, the stock market just doesn't appear to be getting the same signals I am. I don't know. We got some wires crossed somewhere. Somebody check Jack's wiring, I guess. I don't know. Shifting gears to currency here, Egypt devalues their currency by more than 35% after a big rate hike. The decision by Egypt likely paves the way for a new IMF loan deal, and the proceeds from the UAE investment are crucial to enabling the devaluation. If you're holding Egyptian pounds, your life just got a whole lot harder this morning. Egypt hiked interest rates and allowed its currency to weaken more than 35% in a long-awaited devaluation that may pave the way for billions more in loans from the International Monetary Fund. The government will hope it's enough to ease a dire shortage of foreign exchange that's hammered businesses and caused the cost of import goods to soar. The devaluation may add to inflationary pressures and hurt Egyptians in the short term, but President Abdel Fattah el-Sisi and his officials are banking on the reforms attracting foreign investors back to the country of 105 million people, whose stability is seen as crucial for the wider Middle East and ending its worst economic crisis in decades. Egyptian media reported that the deal with the IMF could be signed later on Wednesday. A team from the Washington-based lender is in Cairo this week. The new pact will likely increase Egypt's current IMF loan to $3 billion, little of which has been dispersed to more than $10 billion, an amount that will include funds from other partners. So they've got this $3 billion loan from the IMF that they haven't even used yet, and they're negotiating to increase that to 10. That's a little bit of a head scratcher here. The pound plunged and crossed 50 per dollar at 1:30 p.m. local time, having traded at about 30.9 for the past year. That's the official exchange rate, which the black market rate was much lower than that. It started dropping minutes after the central bank raised its key rate by 600 basis points to 27.25% at an unscheduled meeting, and said it will allow the market to determine the exchange rate. The devaluation came after Cairo struck a $35 billion deal late last month with the UAE to develop parts of Egypt's Mediterranean coast and elsewhere. Authorities described it as the biggest foreign investment ever secured by Egypt, and the scale took investors by surprise. Now, check out this chart of the Egyptian pound versus the US dollar. This is the number of pounds it takes to make $1. And look what these are one-day candles, guys. And look what this thing did this morning. Yikes. Keep in mind, this chart moving higher means it takes more Egyptian pounds to make $1. So this is the pound weakening versus the dollar in a big way this morning, starting the day yesterday at 30.8, rocketing as high this morning as 50.7, currently at 49.6. And it's been a rough year for Egyptian savers, because let's zoom out on this chart and you can see, guys, just a couple of years ago, back in, let's say, 2014, it took 6.9, maybe 7 Egyptian pounds to make $1. And now here we are 10 years later, and it takes almost 50 to make $1 US. How are you supposed to save for retirement? How are you supposed to build anything? How are you supposed to get anywhere in life when you're swimming against a tide like that? Just no chance for the average Egyptian saver in this environment. Also coming in this morning, back in the States, we got ADP's private payrolls this morning. Private businesses in the U.S. hired 140,000 workers in February of 2024, following an upwardly revised 111,000 in January, but slightly below forecasts of 150,000. Services providing companies were responsible for 110,000 jobs, while goods producers added 30,000. Leisure and hospitality reported the biggest increase at 41,000 jobs. Now, guys, I would just add that we have seen huge swings between ADP and the non-farm payrolls number from the U.S. Census. Is it the Census Bureau or the BLS that puts those out? The government numbers have varied widely from the ADP numbers lately, so I'm not going to make too many conclusions based on the ADP number. Let's wait for the non-farm payrolls on Friday. Those have been, if nothing else, entertaining for the last couple of months. And also, Jerome Powell is expected to reinforce his position that the Fed is not ready to start cutting interest rates, as he testifies this morning. We got some advanced testimony came out right before I went live, and Powell had released this statement. In considering any adjustments to the target range for the policy rate, we will carefully assess the incoming data, the evolving outlook, and the balance of risks, he said. The committee does not expect that it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. In other words, they don't yet have that confidence. Those remarks were taken verbatim from the FOMC statement following its most recent meeting in January 31st. And it looks like right now, according to the CME Group's Fed Watch tool, the odds of a rate cut in March are just 3%. In other words, it's not happened. They're not going to move in March. Looking over at the May odds, it looks like we've got a 79% chance that they don't even cut in May. And it looks like the market is predicting June is the most likely point when they start to finally cut rates at the June FOMC. You've got between the 25 and the 50 basis points, you've got about a 73% likelihood of some rate cut starting in June. And I believe the market is now forecasting 4 rate cuts between now and the end of the year. That was 7 just a few months ago. So the market is starting to slowly adapt to the reality that the Fed probably not going to cut anytime soon. And I want to say thank you very much to Nashville Pasta Man, who says, technically, if you factor in the amount of involuntary sales, they did move a ton of product. Oh, are we talking about Foot Locker's involuntary sales? Are we talking about, what's the word we use for that? I believe shrink is the word that we use for involuntary sales, or should we say non-financed transactions? Stuff growing legs and walking out the door. I'm sure there was plenty of that at Foot Locker. That's going on all over the country. Those stores are closing. I mean, the stores in the cities where people can just walk in and take whatever they want and leave, they're not going to be there in another year. We're seeing that with a lot of the pharmacies, and a lot of the grocery stores are just shutting down in some of the worst hit areas. And unfortunately, that means those areas are going to get even worse because the people who live there that aren't total dirtbags won't have anywhere to shop. And so they're going to have to travel further, pay more money just to get to the store. And so that is a doom loop that makes life even worse for those people, which usually results in even more crime. And the blight and the decay just continues from there. It's a good point, Pasta Man. And, well, at some point, you got to start enforcing the law again. You know, there has to be consequences for stealing stuff. I mean, I don't think that's a radical position. If you steal stuff, you get arrested and you get prosecuted. What a concept. Thank you, Pasta Man. Appreciate the super chat, sir, and the support of the channel. And thank you, Cole Mosh, for contributes to the coffee fund. Thank you very much, sir. I appreciate the wake up juice. I love you too, brother. Thank you for being a wonderful melonhead, sir. I appreciate that. And thank you to the Brojo Show, Gen X the BS. He says tax refunds. Most will shop or pay down debt. Good point. Will they shop or pay down debt? I hope they pay down debt. Let's shrink. If you're wondering what you're going to do with your tax refund, folks, allow me to be the party pooper that I am and just remind people of this chart: consumer credit card debt in America. That is currently at $1,044 billion. If you're wondering what to spend your tax refund on, might I suggest you pay off those credit cards, guys? I just throw them out there. Pay off those BNPL loans. Pay off those credit cards. Get out of that high-interest toxic debt. If you have money sitting in a savings account and you have credit card debt, you don't really have money because you're paying higher interest than you're earning. It's amazing how many people I've had to explain that math to. They just don't get it. And these are smart people, intelligent people that just don't understand. You're paying more interest than you're earning. You don't have any money. So pay down debts. Might I suggest pay down debts, Brojo Show? But hey, it's your money, folks. You do with it what you want. I cannot tell you what to do with your own money. Thank you, Brojo. I appreciate the super chat, the support of the channel. And thank you to No One who says, does same-store sales report in units or dollars? Same-store sales is in dollars. It is not inflation adjusted. Technically, it's a percentage basis, but they are reporting the dollar revenue of those stores. When you hear same-store sales, that is the dollar amount at the same store versus a year ago. And it doesn't account for things like digital. It doesn't account for new store openings, things like that. So it's dollars. They're not inflation adjusted. So if you see 0% same store sales and we've got 3% inflation, that means you sold 3% less stuff. Hope I explained that. Huge difference in the effects. You're right about that, no one. We lowered our prices to keep units up and labor not sustainable. Wow, lowering prices in this environment. So that's rough. That means those margins are getting squeezed. I do think we're going to see more stores start to do that. We're going to see some stores going out of business because their margins won't allow it. And we're going to see some stores that will be hurting because they're squeezing their margins. But when we come out the other side of this, those stores will gain market share because they survived when their competitors didn't. So the solution to higher prices is higher prices. No one. Thank you, sir, for the super chat. and for the support of the channel. And thank you, everybody, for having your coffee with the Melon Heads this morning. We got remarks coming up from Jerome Powell. Let's see if that moves markets today. Thank you to my Patreon supporters. Looking forward to talking to you guys at 3 p.m. Eastern time today for our weekly Zoom get-together. Also, you magnanimous Melon Head channel members, thank you guys. Links down below to all that good stuff. Hi, Mom. Hi, Dad. I love you guys. Everybody, till next time, live small and dream big.